A client called me and she asked me, "Hey, Zaid, do you help with investment properties?" And my answer was, "Do I? Of course I do." Hey everyone, this is Zaid Hanna with the Hanna Group, and today we're going to cover the 7 topics when it comes to an investment property. We're getting a lot of calls from actual first-time homeowners that have purchased a home. They are sick and tired of this market, stock market, crypto, even the money sitting in the bank. Look what happened to the banking system and the collapse of Silicon Valley Bank. They want to pull the money out and put it in an actual tangible asset like a single family home, a condo, a townhouse, a fourplex, whatever, even a commercial property. Now, here are 7 topics that we're going to cover today that's going to give you some insight, some of the ideas to think about before getting into it. Now, of course, you can always reach out to me and I'm happy to help you with this because I've owned multiple properties, I've invested, I have investment properties, tenants, and all of the above. So let's start with question number 1, or topic number 1. How are you going to pay for this property? Where's the money coming from? Is it sitting in a savings account or is it in a stock account? Now, both of those have a time and a tax implication. Identify how long do you need to consolidate. Topic number 2. Are you going to pay for it in cash or are you going to obtain financing? Now, of course, if you're going to occupy the property, all you need is as low as 3.5% down or 5% down or even 10%. When it comes to an investment property, you need 25% down, sometimes 40 to 50% down for the numbers to, of course, make sense. Now, topic number 3 is the exit strategy. I know I'm not saying it as the 7th, I'm putting it right in the middle because it's very important. Now, some folks like to buy a property and say, "Zaid, I am going to hold on to this forever and I'm going to give it to my children and I will never sell the property." That is a completely different strategy versus, "Zaid, I would like to buy the property for the next 5 years so I could exchange it into a larger property," and so on. So the most important piece when it comes to that is simply identifying where are we going to buy it, because we need to see upside short-term versus long-term when identifying the property or even the area. Number 4, when we look at cash over cash, aka when we talk about cap rate, what is important to you? Now, when we look into, for example, Bay Area or the coastal areas of California, you get to find out that the cap rate is very low, sometimes 1 to 2 to 3%. So that is very low in comparison to when you go outside, like a fourplex in Central California or even Texas or Nevada. So identifying that to say, "Zaid, I want a cap rate of 10%. So what some investors do, they say, "I want cash over cash on a monthly basis versus cash over cash 5 years from now or 10 years from now." So they identify that, okay, I'm okay if I'm buying a property in California and it's covering my cost, I am happy to hold on to it long term because when I sell the property, I am going to make that money versus, "Hey, I want cash flow now and I want a property that's going to generate $500 a month for me or $2,000 a month for me so I can continue to live this lifestyle so I don't have to work as hard." Topic number 5. We talk about areas. Which area is more important than others? For example, 5 years ago, we were talking about the Opportunity Zone that's in downtown San Jose and a few other areas versus, "Hey, did you know that Sunnyvale 3 years ago, if you had bought there before Amazon, Facebook, Google bought all that real estate there, including Apple, it jumped up so much." So the question becomes do you want to buy in an area that's already established or you're looking for an opportunity pocket to identify, okay, what's the hottest thing? So identifying the area, that's also very important. Number 6 is to go it by yourself or bringing a partner in. This could be a friend, this could be a family member, a brother, sister, it doesn't matter. I always talk about the exit strategy together, meaning, hey, how long do you see this investment? Are you okay in holding on to it 5 years from now, 10 years from now? Identify your rules and put it in writing, because you don't want to lose that relationship over this investment. So this one is very important. And number 7, understanding the tax implication. So I always say consult with your tax person to give you some insight about depreciation. When you own a property, you're going to have rental income. How can you write that off? By the way, if you are the tax person, consult with the tax person. You want to have all the information that's needed because you can do, for example, a cost segregation. That's when you buy the entire property, commercial, residential, you could do it too, where you could actually write off the entire cost that year so you're not paying any taxes on your income. Now, of course, again, consult with your CPA so they can give you some insight. So these are the 7 points. There are many, many other micro points. We can go into it. If you're thinking about investing, do reach out. I'll guide you through this process. 408-515-1613. Bye-bye for now.